Commodities have always played a critical role in the global economy. From steel and copper to aluminum and rare metals, mining companies provide the raw materials that power industries around the world. As infrastructure spending rises and the demand for natural resources continues to grow, many investors are looking toward mining ETFs as a way to gain exposure to this sector. One of the most widely discussed funds in this space is the SPDR S&P Metals and Mining ETF, XME, an ETF designed to track a broad group of metals and mining companies. In 2026, this fund remains one of the most watched options for investors interested in the mining industry. The XME ETF focuses on companies involved in the production and processing of metals and mining resources. Unlike funds that concentrate on just one commodity, XME provides exposure to multiple industries within the mining sector. This includes companies involved in steel production, coal mining, aluminum manufacturing, and other industrial metals. One of the main advantages of XME is diversification within the mining industry itself. Instead of relying on the performance of a single mining company, the fund spreads its investments across many firms operating in different parts of the metals market. This helps reduce the risk that comes from depending on one commodity or one company's performance. Mining companies tend to benefit during periods of strong economic growth. When global economies expand, construction projects increase, manufacturing activity rises, and demand for raw materials grows. This often leads to higher prices for metals, which can boost revenues for mining companies. Another factor that influences the mining sector is government infrastructure spending. Large-scale infrastructure projects require massive amounts of materials, such as steel, copper, and aluminum. When governments invest in transportation systems, power grids, and construction projects, the demand for these metals can increase significantly. XME also reflects trends in the global supply chain. As industries continue expanding and new technologies emerge, the need for industrial metals remains strong. For example, renewable energy systems, electric vehicles, and advanced electronics all require various types of metals produced by mining companies. However, investing in mining ETFs also involves certain risks. Commodity prices can be volatile and often respond to global economic conditions. When demand for metals slows, mining company revenues may decline. Additionally, factors such as environmental regulations, operational costs, and geopolitical developments can affect the mining industry. Despite these risks, many investors include mining ETFs like XME in their portfolios as a way to gain exposure to the broader commodity cycle. Mining companies are often considered cyclical investments, meaning their performance tends to rise and fall with economic activity. For investors who believe global demand for metals will continue growing, XME offers a diversified approach to participating in the mining sector without needing to analyze individual mining stocks. As the world continues building infrastructure, expanding renewable energy systems, and developing new technologies, the demand for industrial metals remains a key driver of economic growth. ETFs like the SPDR S&P Metals and Mining ETF allow investors to gain broad exposure to the companies supplying these essential resources. While commodity markets can be unpredictable, mining ETFs remain an important tool for investors looking to participate in the global demand for raw materials.